Stop what you're doing. If you own or even just follow medical device stocks, you absolutely need to see this. Welcome to The Explainer. Last week, I ran LeMaitre Vascular's Q1 2026 earnings through a deep fundamental breakdown, and honestly, what I found completely shocked me. It's the ultimate fear for us retail investors, right? You buy into what looks like a total breakout only to get absolutely crushed in a post-earnings trap. But here's the thing. While the broader market is panicking over a few minor guidance misses, they might be completely ignoring one of the most profitable, deeply entrenched moats in modern healthcare. So today, we are tearing down LeMaitre Vascular's Q1 numbers, and by the end of this explainer, you will know exactly if this recent stock pullback is a dangerous value trap or literally the biggest hidden gem buying opportunity of the entire year. 72.7%. Let that sink in for a second. In the medical hardware space, where aggressive hospital consolidation is squeezing margins across the board, posting a gross margin north of 70% is a staggering, almost unheard of statistic. It's wild. It means this company operates less like a traditional business and more like a toll bridge right inside the operating room. That incredibly high margin, it's fueled by highly specialized manufacturing efficiencies and some serious, undeniable pricing power. Pricing power that most mega-cap competitors could only dream of having. When a company can hold on to almost 73 cents of every single dollar in revenue before operating expenses even kick in, well, it creates a massive cushion for future investments and shareholder returns. Which brings us to this bold, kind of seemingly impossible question. How on earth does a niche medical device company post a massive 42% earnings per share growth only to see an immediate 10% share price pullback that very same day? Make it make sense. That massive disconnect between brilliant past performance and brutal forward-looking market reaction is the central puzzle of this explainer. What this means for your portfolio is that somebody has to be wrong here. Either the market is completely overreacting to short-term noise, or the fundamentals are hiding a much larger structural crack. To figure this out, here's our roadmap. We'll start by deciphering the earnings paradox, then look inside the Q1 2026 results, and analyze their surgical niche moat. After that, we'll weigh the endovascular threats, contrast their dividends against insider sales, and finally reveal Wall Street's verdict. Okay, let's dive right into this. Section 1. The earnings paradox. Deciphering the market reaction. So, LeMaitre just posted $66.6 million in sales for the first quarter. That translates to a really solid 11.2% year-over-year jump. By all traditional fundamental metrics, this was a fantastic, highly profitable quarter. It proved their products are still in super high demand. Yet, the market responded by slashing the stock price by 10% immediately after the closing bell. This is basically a classic example of how earnings season can decouple entirely from backward-looking fundamentals. So what was the culprit behind the drop? Well, Wall Street completely fixated on the relatively softer future guidance. Despite the massive Q1 beat, LeMaitre guided Q2 earnings per share to a slightly muted range of 79 to 84 cents. When you pair that with their full-year sales expectation of $277 to $283 million, boom, it created an immediate information gap. The narrative shifted in a matter of seconds from, wow, look at this incredible growth, to a massive wave of caution. It left investors wondering if this growth is actually sustainable. In medical devices, forward-looking predictability is literally everything. Any crack in that armor gets punished severely. Moving to Section 2, inside Q1 2026 results, a staggering quarter. Let's just strip away the market's emotional reaction for a second and look strictly at the hard data. Now, what's really interesting about this is the underlying numbers show genuine, undeniable strength across the board. They hit a highly impressive 10% organic growth rate, and that organic designation is absolutely crucial. It means they are growing inherently through their core operations, selling more volume, raising prices, rather than just relying on expensive acquisitions to artificially pump up their top line. The operational leverage here is firing on all cylinders. Operating income surged by 41% to $17.8 million. When your operating income is growing nearly 4 times faster than your overall sales, it proves management is keeping a really tight lid on expenses, letting that revenue fall straight to the bottom line. But you can contrast that incredible leverage immediately with the exact guidance targets that spooked Wall Street, with Q2 sales guided to a midpoint of just $71.5 million. There is a clear, glaring tension between their cautious future outlook and the beautiful reality of their current operational leverage today. And this momentum, it's building globally. It isn't just coming from price hikes in a single isolated market. Their flagship biologic, Artegraft, grew an incredible 36% worldwide. All 3 main geographies posted record sales. EMA was up 20%, APAC jumped 18%, and the Americas grew 7%.
This completely validates their international launch strategy. It proves it's gaining real, sustainable traction. Getting regulatory clearance and building sales networks in foreign markets is notoriously difficult for mid-sized medical companies. So seeing these double-digit international growth numbers, that's a massive de-risking event for long-term investors.
Section 3, the surgical niche moat, a David versus Goliath strategy. So how does a company with a modest $2.57 billion market cap survive, let alone post mid-70s gross margins, against massive giants like Medtronic or BD? The answer is targeted, fiercely defended niche dominance. They don't try to win everywhere. They just try to be utterly indispensable in one specific room. LeMaitre has built a deep, incredibly defensive moat around surgeon-centric products. Because the company was actually founded by a surgeon, Dr. George LeMaitre, they've maintained a hyper-specialized direct sales force. These reps offer high-touch operating room support, which secures incredibly sticky long-term preferences among vascular surgeons. It's very much a relationship business at the clinical level. Think about it. When a surgeon finds a specific tool they trust with a patient's life, they rarely switch just to save the hospital a few bucks. For us as investors, understanding that clinical loyalty is literally the key to understanding their immense pricing power. Breaking down the core Q1 growth drivers paints a really clear picture. We've got Artegraft up 36%, synthetic and EPTFE grafts up 20%, valvulotomes up 15%, and carotid shunts up 11%. Every single one of these posted record sales. Because these are specialized, low-volume tools with very few direct substitutes, LeMaitre commands the premium pricing that directly feeds those spectacular gross margins we talked about. Megacap companies simply don't have the agility or honestly the financial incentive to try and disrupt these smaller, highly specialized product lines that basically leaves LeMaitre virtually unchallenged in their chosen verticals. Which brings us to Section 4, endovascular and industry threats, the existential risks. As much as we love the moat, we have to pivot and examine the bearish signals impartially. Every medical device company faces disruption, and LeMaitre is definitely not immune to shifting macro industry trends that actively threaten their core open surgery market. Ignoring these risks would be a fatal flaw, and this brilliantly illustrates the tension. On one side of the scale, you have LeMaitre's open surgery moat and incredible surgeon loyalty, but bearing down on the other side are some real existential threats. The medical industry is rapidly shifting toward minimally invasive endovascular care, led by companies like Penumbra and Inari Medical. This actively reduces the total volume of traditional open surgery cases. If fewer patients are getting cut open, demand for LeMaitre's core products inherently shrinks. Furthermore, those Goliaths we mentioned earlier, they are aggressively using integrated delivery network hospital bundling to squeeze out standalone niche players like LeMaitre during the hospital procurement process. They offer these bulk discounts that a smaller company simply cannot match. Next up is Section 5, dividends versus insider sales, mixed signals for shareholders. This brings us to capital allocation and insider actions. These two areas are currently creating immediate tension and deeply mixed signals for retail investors trying to properly value the stock right now. On the highly bullish side, we have a 25% year-over-year dividend growth. LeMaitre just raised its quarterly dividend to 25 cents, bringing the annualized payout to a full $1 per share. That is a very confident, aggressive signal for management that underlying cash flow is not only strong today, but highly sustainable into the future. A 25% hike isn't just a token increase. It shows a massive commitment to returning excess capital to shareholders, precisely because their niche moat requires very little ongoing capital expenditure. But wow, that bullishness is immediately met with a heavy bearish juxtaposition, $23.1 million. Over just the last 3 months, insiders, including the CEO, have sold exactly 215,438 shares worth over $23 million. Now, to be fair, insiders sell for tons of personal and financial reasons. It could be taxes, diversification, or planned trading schedules. But seeing that massive volume of sales right alongside softer future guidance, it certainly gives cautious investors a valid reason to pause and reassess. It forces the question, if the future is so bright, why are the architects of the company taking so many chips off the table right now? Finally, Section 6, Wall Street's verdict, consensus and price targets. So how do we actually weigh all of this? Let's bring this explainer to a climax by revealing exactly how institutional analysts are measuring these fundamental pros and cons following the Q1 release. Currently, across 8 major Wall Street analyst ratings, LeMaitre holds an average moderate buy consensus. The breakdown sits at 1 strong buy, 4 buys, and 3 holds. Interestingly, their average forecasted 12-month price target is sitting at $112.60. That implies nearly a 23% upside from their current trading price. It's a highly attractive margin of safety for potential investors who believe the Q1 sell-off was fundamentally unjustified.
So the crucial point is this. Despite the very real endovascular threats, the hospital bundling pressures, and that massive $23 million in insider selling, major research firms confidently upgraded the stock following the Q1 results. Roth MKM boosted their target to $117, and Zacks Research actually upgraded LeMaitre to a strong buy rating based on this data. These institutions are clearly betting that the 72.7% margins and the sticky clinical relationships offer far more downside protection than the market is currently pricing in.
Which leaves us with this final provocative thought for you to chew on. Do LeMaitre's staggering 72.7% margins, their undeniable Q1 global growth, and their sticky open surgery moat outweigh the long-term endovascular threats and heavy insider selling? It's a fascinating paradox, and honestly, exactly the kind of puzzle that separates the focused, profitable investor from the rest of the crowd. Take a really close look at the data, weigh these forces for yourself, and keep learning. Thanks so much for joining me for this explainer, and I'll see you next time.